I think we can start because we don't have time. So good evening once again. You are welcome to Equity Professional Limited. My name is Adebayo Desalu. I will be your anchor facilitator for today. And today, this class is, I want to be everybody in this class are for, that they are for this paper, Audit Assurance and Forensics, skills level. That is what we are having today. And we are two facilitators for this paper. I'm the leading facilitator, while the other facilitator will come in the next class and subsequently like that. I've shared the course application on the platform. You can check to see who does what at any point in time. You can use that to monitor the progress of the class. All right. So I'm starting with the first chapter, which is chapter 1, the need and concept for assurance. Now, what we mean by this is that, and one thing you need to understand here is that you are all welcome to this class, and what we intend doing is to ensure that we're able to equip you for the forthcoming November 2026 ICAN examinations. So we believe that as you come on board, as you join us, you are going to be able to learn. You are going to learn how to answer ICAN questions, how to understand some audit terminologies. You are going to start the foundation from now. They are going to unlearn some of those things that you have learned before in audit, that as of today, they are no longer applicable. And should you use them in the forthcoming examination, it could impact negatively on your score. So you are going to ensure we disabuse, we purge all of that out of your system. They are going to relearn, meaning that we are going to equip you with new strategies. We are going to equip you with new methods. We are going to new approaches, new terminologies that will fortify you, equip you better for the forthcoming ICAN exam. So that when you go for the examination, you write the examination and you come out successfully. Student failure in any paper start from the exam hall. If you enter an examination hall and you are not fully prepared, that is where the failure starts from. But when you enter the examination hall, you are fully prepared, your level of confidence is high, then that paper is going to be a walkover for us. So that is what we intend to do here at Equity Professional Limited, and you're all welcome on board. So let's go on to chapter 1. Chapter 1, like I said, is the need and concept for assurance. Now, this is going to build us, we are going to use this chapter to lay foundation for the paper. Now, anytime you talk about assurance or audit, so to say, we have a body that regulates the practice of audit and assurance services globally. And the name of that body is the International Audit and Assurance Standard Board. That is the body that has been sanctioned or empowered to implement and to monitor or supervise the practice of audit and assurance globally. Now, this body, like I mentioned, International Audit and Assurance Standard Board, is a committee in the IFAC. It's a committee of IFAC, that is International Federation of Accountants. So the International Federation of Accountants is a bigger body that regulates the practice of accounting across the world globally. And you know that from that IFAC, you have other subcommittees. You have the IASB, International Accounting Standard Board. You have the International Audit and Assurance Standard Board, IASB. You have International Ethics Standard Board for Accountants, and you have a whole lot of other subcommittees that are under the IFAC. Okay, so for us, this particular paper, we are going to focus majorly for this chapter. We're going to focus majorly on this body, that is International Audit and Assurance Standards Board. Why? Because it is that body that is empowered to regulate the practice of audit and assurance globally. And they have given us a definition of the word audit. Now, audit comes from an Italian word, it's a Latin word that means to hear. Now, that was the initial concept, the initial understanding, the foundational basis for audit is to hear. Why was it to hear? Now, we need to understand and appreciate that audit that we are seeing today, that we are practicalizing today, was not like this when it started. And I need to let us know that audit is as old as human existence on Earth, planet Earth. And you need to also understand that as at that time, it was not as sophisticated as it is now. As at that time, what they were doing is strictly manual, is strictly not documented in such a way. So what happened, why they call it to hear is that somebody will be giving, someone that has a particular character in his community or in a society that has been proven and tested to have that character, that good character, will be bestowed with the honor to oversee the properties of the rich people within the society, the men of authority within society, and is going to give record, going to render account of stewardship to the owner of those assets or assets or whatever that has been put in his care. So when he's reading out the report, they will listen, and that's why I got the word audit from the Latin word. All right. So that word is an audit terminology, right? And that terminology has been defined by the International Audit and Assurance Standard Board as an independent examination of an expression of opinion on the financial statement of a business enterprise by an appointed auditor in accordance with the terms of appointment and in compliance with relevant statutory and professional requirements. Now, for your exam, you might need to commit this to memory. But if you cannot commit it to memory, you should be able to paraphrase. Paraphrase here means there are some keywords that are here that when you are trying to define it in your own way, those terminologies must be included. If they are not included, it might shortchange or reduce the mark that you're supposed to get from there. So before you try to memorize it, if you have an understanding of what the definition is, then is going to facilitate your comprehension of whatever you are trying to commit to your memory. So let's start. Let's break it down gradually. Audit is defined as an independent examination. What does that mean? So what that means is that there is someone that has been appointed to do what? To examine the financial statement. Okay, it's looking at financial records of an organization. That person is not a staff of the organization. That person has been appointed, meaning that there are processes that led to the appointment of that. We are going to look at that subsequently, okay? So that person that has been appointed to examine the financial statement, he or she not being a staff of the organization, means that that individual is going to work independently of the management and the board of directors. Did you get it? So what that implies is that what we are trying to say is this, and I don't want to be too fast, but I need to say it, even though as we progress, we are going to see most of the things I've said now. So what I'm trying to say is this: the owners of the business, some of them do not understand the financial statement being prepared or financial record being prepared by the people that they have put in charge of that organization's management. I take it again. Business owners, most of them do not have the literacy of interpreting financial information, but they have employed, they have appointed people to manage the business on their behalf. So if whether the people that they have appointed or employed to manage business on their behalf, whether they are doing it in their own, in the best interest of the owners of the business, or in their own personal self-interest. The only person that can prove that is where you have a neutral person that has been appointed to review that, a neutral person that is equipped with the knowledge to interpret financial information to or on behalf of the owners of the business. That is where the auditor comes in. So it's not a stooge. It's not an extension of the management. Neither is it an extension of the board of directors. He's standing on his own. And he has been given a mandate. These are the things we want you to do. And because of that, he's going to work based on the scope of work that has been assigned to him. So that's what we mean by an independent. Is acting without the influence of either the management or the board of directors. I hope that is clear. And he expresses expression of opinion. Look at it here. Expression of opinion on the financial statement of a business enterprise. So what that means is that after he has examined the financial statement, he needs to write a report. You need to let them know that I've examined financial statement. These are my findings. And for my findings, I can tell you that I can boldly say emphatically that the financial statement or financial records are in order or they are not in order. He has to take a stand. That stand that he's taking, it's what determines whether the owners of the business are in support or the owners of the business believe that the people that have been appointed to run the business on their behalf have either changed them or not. So if they have not been keeping proper financial record or information, it means that they have been acting in their own selfish interest against the interest of the business owner. Does anybody have any question as we proceed? Are we together? Any question? Hello, class.
Sir.
Please ask your question. Does anybody have any question?
None at this time.
Are we all together?
Yes, sir.
Okay. I want to believe that he is speaking for every other person on this call. So that is what we mean by that, okay? So the professional or the auditor, as the name, that is the name of the person, is not any person, is a professional or is an auditor, right? The auditor has been appointed to independently examine the financial statement and express an opinion on the financial statement of a business enterprise. So he has to do this in accordance with the terms of appointment and in compliance with relevant statutory and professional requirements. What does this mean? What this means is that when you are appointing an auditor, an external auditor, mind you, there are two types of auditors. We have external auditors and we have internal auditors. For this particular chapter that we are discussing, we are making reference to the external auditor, not the internal. We are making reference to the external auditor, okay? Now, as an external auditor, there are conditions that must be fulfilled in line with, according to CAMA. CAMA is Companies Allied Matters Act 2020 as amended. There are conditions in CAMA 2020 as amended that stipulate how you should appoint an auditor. What are the things that must be in place when you want to appoint an auditor? So they must follow the laid down rules for that. All right. And after the auditor has been appointed, he must ensure he acts within the confines of that law, because that same law still stipulates what his responsibilities are. He's not just acting anyhow. There are laid down things that he needs to do. And the primary purpose of appointing an auditor, please note this. Note it and commit it to your memory now. The primary purpose of appointing an auditor is not to express an opinion. The primary purpose of appointing an auditor is to examine the financial statement first and be sure that the financial statements have been prepared in line with applicable financial regulatory framework. That the financial statements have been prepared in line. Madam Dorcas, please mute your mic. Mute your mic, Madam Dorcas, please. Thank you. Thank you. Because you are distorting my line of thought. All right? So, like I said, the main duty, the main responsibility of appointing an auditor, external auditor, is to ensure that the financial statements presented by the management to him or her has been prepared in line with applicable financial regulatory framework. That is, Mr. Who is this? Amarachi, please mute your mic, madam. Please mute your mic. I don't want any distraction, okay? So that we can finish in good time. Thank you. So that is the main duty. It's after that has been established by the auditor that you can now say, okay, other things can now follow. If that has not been established, there's nothing the auditor is doing. If he cannot ascertain that financial statements have been prepared in line with the applicable financial regulatory framework, then there is no basis for the examination of the financial statement, because he has to benchmark the financial statement with the laid down financial reporting framework. Okay, he has to be sure it's in line with the applicable financial reporting framework. After benchmarking, after comparing with that's when they can say, okay, the financial statement is prepared, is okay. Then it can continue. But if that has not been proven right, there is no need for the auditor to continue with the auditing. All right, and that's what they mean here by appointed auditor in accordance with the terms of appointment and in compliance with relevant statutory and professional requirements. So there are requirements that needs to be fulfilled as well. You cannot just appoint anybody as the external auditor. There are certain conditions that must be met. All right, so we're going to look at that subsequently. All right, so that is the definition of an auditor. That is the definition of an auditor. The auditor main responsibility, I'm repeating it again, is to ensure that the financial statements of the business enterprise have been prepared in line with applicable financial regulatory framework. That is the ultimate responsibility of the external auditor. All right? Now, let me explain this in another way so that you get what I'm trying to say. You have a Dangote that owns businesses, chains of businesses all over. And you all can attest to it that Dangote is not a chartered accountant. Right? Neither is he a financial analyst. But he has employed chartered accountant, he has employed analysts, financial analysts, to help to run his business or businesses. So at the end of the day, when he presents the reports to him, he could barely understand what is in that report because the figures are prepared in a particular format that he may not understand. But because he knows that, okay, there should be checks and balances, there should be somebody that can interpret this report or this financial information or records to him in a better way, what will he do? He will engage the services of external auditor, like the KPMG, PwC, Deloitte, or S& Young, and any other audit firm around, and ask them to come and help him to be sure to assess this report, whether these people that he has employed, they are not acting against his interest. Okay, that's when they come in. And when those people come in, they are not coming in to come and say, okay, management, let me see your report. Okay, no worry, we are working together. I'm going to shade you. No, they are working independently. If they have any question, they can ask the management, they can ask the board of directors, but they are acting independently of this board management of that organization. Okay, now the applicable financial reporting framework that we are talking about is decided by legislation within each individual country. In Nigeria, as we speak today, what is our framework, financial reporting framework that we have adopted? It is the IFRS, National Financial Reporting Standards. That is what we are using as our framework in Nigeria. If we are in US now, we'll not be talking about IFRS. We're talking about the US GAAP, generally acceptable accounting principles. That's what we're talking about. That is in US. But in Nigeria, what we are currently have adopted is the IFRS as our financial reporting framework. And we're talking about the applicable financial, we're talking about the applicable financial reporting framework. We're also talking about the accounting standards. What are the accounting standards? You have them in your IFRS. We have the IAS, it's National Accounting Standard, IAS, and you have the International Financial Reporting Standards. That is what we are talking about, okay? So the auditor seeks to express an opinion as a result of the audit work that is done. So after he has ensured that this is done, then he can now say, oh, this is how much your management, your people are supporting your vision or your objective. Okay? I hope that is clear. Any question? Any question? We are good, right? Okay, let's go to the next slide. The concept of accountability, stewardship, and agency. Now, what do we mean? Now, when you talk about accountability. Now, accountability, stewardship, and agency are key terms, audit terms that you need to know at this level. Okay? Now, let's look at it this way. If you look at the management, now let's start from here. A business is divided into two. There are two sets of people that exist in a business or in a company, in an organization. The owner of the organization and the people that he has employed to manage or run the organization. The owner of the organization can be termed as the what? As the shareholder, right? That is the owner. That means the ownership rests with the shareholder. But the management of the organization rests with people that have been employed or appointed to run the business. In some organizations, right, the owners, especially for the sole proprietorship businesses, the owners of the business are also the management of the organization, because the person that owns the business is the same person that manages the organization. And when the person dies, most times there is no sustainability. That business will also die. All right? But when the company is established as a limited liability company, that means that the company is properly formed, registered with CAC, Corporate Affairs Commission, and it follows all the guidelines of that company, of setting up a company. Then that means that that business is no longer a sole proprietorship business. It has now been established as an entity. So what that means is that that business is different from the owners of the business. So that means if I say PLC, if I say Dangote Limited now, or Dangote PLC, what I'm saying is that Dangote PLC is different from Alhaji Aliko Dangote. They are not the same. Dangote PLC is an entity. Alhaji Aliko Dangote is another entity. So there is separation of what? Separation in the entity, separation of entity. Dangote is an entity, the business is an entity. So if the business wants to borrow money from the bank, for instance, for expansion, they're not going to use the name of Dangote, Alhaji Aliko Dangote to go and borrow money from the bank. They are going to use the name of the company, Dangote PLC, to go and borrow money. So if the bank, if the loan becomes bad, for instance, right, they will not come to, it will take time before they get to Dangote, Alhaji Aliko Dangote. They first of all go to the company, first of all, and see how they can, whatever they can salvage to reduce the liability before they can even get to him. Do you understand what I'm saying? That's what they mean by ownership. Okay? And management. You understand the two now. Now, the management are people that have been appointed to run the business. Now, there's even between board of directors and management. Board of directors are people that have been appointed to supervise and coordinate. They are the ones that even employ the management. So what they don't involve in day-to-day running of the business, but they have a way of supervising what is being done across the business or within the business. So they will appoint the management. The management is involved in the day-to-day running of the business, and they are going to send their report to the board of directors. That is where it is run. Now, the owners of the business that have appointed the board of directors to run the business on their behalf, they are going to give an account of how they have managed the business. And when they are doing that, what they are doing is known as what? Accountability. They are rendering an account of what? How they have been able to sustain the business or to manage the business on behalf of the owner of the business. Is that clear? That's what we mean by accountability. You take ownership, you take responsibility. If the business thrive, if the business continue to be successful, they take the glory that they are running the business very well. And the business is not performing well, they also take the blame for not performing well because it is their responsibility to ensure the business performs. That is where accountability comes in. All right. Now, when you talk about stewardship also is similar to accountability. But what that implies is that stewardship, what that means is that you have been, you remember how I started audit? I said audit started from the olden days, where I said that the rich people, they look within society and appoint somebody that has good character, right? And the person will be appointed to manage the business on behalf of the owner. At the end of the day, the person will give an account of what he has done. What that person is doing at that point in time is what we call stewardship role. When you appoint somebody to manage your business, that person is acting as your steward. You understand? That person is doing what? Is working as your what? As your steward. So that role that person is doing is what is called what? Stewardship. I'm able to define accountability. I'm able to define stewardship. Agency. Agency means you are an agent. Agent means in agency law, we talk about agent and the principal. That means in agency, all we are saying here is that the agent is important to always act in the best interest of his principal. What that means is that if you employ someone now, let's say as your maid in your house, to work for you as a maid, you are the principal. That maid is your agent, so to say. So you are going to give instructions to your maid. This is what I want you to do every time. It's essential that maid will honor and obey and comply with whatever you ask the person to do. Even when you are not there, you will say, Oga said, Madam said, that's what the person will be saying. So that is what agency means, right? So what we are saying here is that for the board of directors and the owners of the business, there is that agreement. They are also acting as what? Agents for the owners of the business, because the owners of the business have said that I'm setting up this business, I want the business to make profit. Don't worry, sir, we are going to do it for you. They're acting as the agent. All right. So that's what we mean by that. All right. So they are acting as agents. Now, another way to also look at agency is looking at it from the angle of the management and the board of directors. They're also acting as agents. The management is acting as agent for the board of directors, because one way or the other, they are going to give account of how they have managed the business to the board of directors. The board of directors, like I said, they are involved in the running of the business, but not on a daily basis. They come in maybe quarterly, or they come in annually when they're having their AGM. And that's when they come in. But the sales management, they are involved in the running of the business every day. All right. So that is what we mean by agency. So I've been able to define agency, even though they are somehow related. I'm going to define agency, stewardship, and accountability. Any question? Any question? Any question? Any comment? Are we good?
Yes, sir.
All right, so let's continue. Now, when the auditor is appointed and is done examining the financial statement, he's going to write a report. That report that he writes or she writes is a report that is going to determine the decision that will be taken by the owner of the business. That report that he writes is going to determine the decision that has been what? That will be taken by the owners of the business. That report is called the auditor's report. Now, the auditor's report is going to contain the information the auditor has gathered while examining the financial statement. It's going to give an independent opinion on what he observed while examining the financial statement. And it's going, after examining, after giving his observation, is going to also report, is going to take a position whether the management and the board of directors, they are acting in the best interest of the owners of the business or not. That is, the financial statement that is being presented is prepared in line with applicable financial regulatory framework or not. It needs to also state that. Okay? Then it needs to also ensure that, knowing fully well that as an auditor, because of time, you might not be able to look at everything in its totality or in its entirety. You might not be able to look at it holistically. There's what we call audit. We call it audit sampling, or we call it risk-based audit. In auditing, there's what we call audit sampling, and there's what we call risk-based audit. They are not the same. When you talk about audit sampling, what it means is that you are taking a percentage of the population and using the result of that percentage taken to conclude on the entire population. What that implies is this. So let's make you understand what I'm saying. So you have, let's say you have 10 Igbos, or let's say you have 100 Igbos. I'm just using a hypothetical case study now. You have 100 Igbos in, let's say, in an area, right? And out of these 100 Igbo men, you're able to take sample of, let's say, 10 of them. You just pick them systematically, right? You pick them, maybe one from each particular group or whatever. You're able to select what? 10 out of 100. Now, those 10 that you have removed, and those 10 that you have sampled, whatever you are going to, let's say you want to test them for, maybe for integrity or whatever, you can say that, okay, maybe the 10 that you selected, you now found out that all the 10, they are trustworthy. So what you are going to say is that from the audit I've done, the 10 that I've used as sample prove that all the Igbo men that are in this community, they are trustworthy. But if it's the other way around, let's say, okay, 10 of them, they could not be trusted. You say that from the analysis, from the audit, these 10 have selected shows that it represents population that all the Igbo men, the 100 Igbo men that are there, they are not trustworthy. That is what it means. All right. So why is that so? Because the auditor does not have the luxury of time to try and examine each and every person in that community. The same thing with the work the auditor is doing. The auditor cannot check everything that they have put in financial statement 100%. It's going to do what? Sample. All right? It's going to do what? Sample. That's what we mean by sampling. I hope that is clear. When you talk about risk-based audit, risk-based audit means the auditor, while performing his audit, is going to focus on the key areas of the business. Areas that, if anything should happen to, it could impact the business negatively. That's what the auditor will focus on. We call it risk-based audit. Focusing on the key areas of the business. We call it risk-based audit. That is, if anything should happen to those areas, the business can be what? Cannot survive or will not survive. Okay? That is that. I need to let you know about that. So what we are saying, why am I saying this? I'm saying it because I'm using that to explain the concept of what? Materiality. So as an auditor, you might not be able to, because you don't have luxury of time, you might not be able to sample everything. You might not be able to look at, examine everything. But the ones that you have examined, to what extent can you say it is correct? To what extent can you say it complies with the applicable financial reporting? To what extent? If the extent to which you can say is high, let's say out of 100%, you can say 80% is okay or is correct. That means that you are fine, right? You may not be able to look at it, but for what you have looked at, you can look at, I've looked at 80% of all the transactions, all the records, and I can tell you that 80% I've covered and I believe that it is fine. So what that means is that you are going to base your decision on the 80% that you've been able to get. And that is where materiality comes in. That means 80% is above average. Okay, 80% is what? Is above average, which means that, okay, realistically or comfortably, you can say that at least it's okay. It's not excellent, but at least it is okay. All right, that's where materiality comes in. Because at the end of the day, the owners of the business is going to make they are going to make their decision based on the information that has been what? That has been provided. Based on the what? Information that has been what? Provided in the report. So if the auditor says that financial statement has been prepared in line with applicable financial reporting framework, that it shows a true and fair view. True and fair view is another terminology. What that means is that true is a phrase, it's an audit terminology that is a phrase. When you talk about true here means the information that is there is correct. No false information. That would mean by true. All right. When you talk about fair means there is no information that is missing or that is hidden or misleading to people that want to make decision. That is fair. But we don't separate them. We always call it true and fair view. You are not allowed to separate them into words, true, and explain what is true and what is fair. The compound terminology is called a true and fair view. What that means is that financial statements have been prepared in line with applicable financial regulatory framework. All right? Now, what you also need to note here is that as an auditor, like I said earlier, you must be able to act independently of the what? Of the management and the directors. Why? You must not allow yourself to be what? To be influenced by them. Okay? You must not allow yourself to be what? To be influenced by them. That is what we mean by that. All right? Now, the materiality that I explained earlier is, we are going to talk about it much later, maybe when we get to planning. But what it means is that is a concept, right, that says that it gives an opinion on whether financial statements have been prepared in all material respects. Okay, this one I've said this one before. What they talk about materiality, what it means is that the auditor will not aim to examine every number in financial statements because this is effort on the more significant items in the financial statement because of these two reasons. You will not be able to look at everything, but it's going to concentrate more on more important significant areas, such as because of what? Either they have higher value or because there is a greater risk that could be stated incorrectly. Higher value here means the value of those transactions are high. Greater risk here means if there is a mistake in those values, for instance, you are not able to get the information, accurate information concerning non-current assets, and you now decided to base your decision on that. You not tell them, you just say that non-current asset is this value, whereas that value is incorrect. That is going to impact the decision that will be taken by the owners of the business. That's what it's talking about, the value and the greater risk that if it is stated incorrectly. Okay, that is what we mean by materiality concepts. Any question thus far? Any question? Are we together?
Yes, sir.
No question, right?
No, sir.
Okay,
I
thank
have
you.
a question.
Please ask your question.
Okay, sorry,
Please go ahead.
didn't get that audit sample. I didn't get the audit sampling, the meaning. I didn't get it.
So what I said, okay, let me explain. Let me ask you. So you get to get what I'm saying. When you talk about sampling, what's your own understanding of sampling? Madam,
Okay,
what's your own understanding of sampling? When they say
okay,
go and
let's say
sample,
that
so
you're
what does it
sampling
mean?
a
Eh?
okay, let's say that you're sampling a product. Let's say that you're sampling a product, you will not bring everything out. Like you give a sample. This is an example, stuff like that.
Okay. That's what you understand by sampling. Okay, good. You have said it now.
Yes.
It's the same thing I just explained. What I'm saying here is this. Auditors, as we speak today, they do not, tomorrow things might change, but as today, auditors do not have the luxury of time. They don't have time to look at everything in the financial statement, right? So because they cannot look at everything in the financial statement, what would they do? They are going to devise a way for them to say, oh, I've reviewed it, I've examined the financial statement, and this is the position I am taking as per the preparation. What will they do? They're going to take a sample. What is this? What do you mean by all this sample? This sample is taking a percentage of a population and using that result to conclude on the population. You take a sample and use whatever result you get as sample is what you are going to conclude. Now, that does not mean that there might not be error. Okay, but we are our own at this moment today, this evening, we are not diving into whether there is error in the sample. We are going to look at that much later. But for now, we assume all things being equal, meaning that the sample that has been taken is correct, and we are using that sample to conclude on the entire population. Is it clearer now, madam?
Yes, it's okay now. Thank you, sir.
All right. Any other question? We are good, right? Okay, so we move ahead. We are now here. Assurance engagement in auditing. Now, we have been talking about auditing before now. We are moving on to another level. This is another terminology, assurance engagement. What do you understand by assurance engagement? First of all, you need to put this one somewhere in your memory. Assurance engagement is audit is a type of assurance engagement. Let me recap. Auditing is a subset of an assurance engagement. What that implies is that when you are performing audit, you are directly performing a type of assurance engagement. Is a type of assurance engagement. What that implies is that assurance engagement is bigger than auditing. Assurance engagement in terms of scope is bigger than auditing. So let's define it. We are going to still break it down as we progress. The same body that gave us the definition of auditing, which is the International Auditing and Assurance Standard Board, IASB, still gave us this definition of assurance engagement and defines it as an engagement in which the practitioner expresses a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of the evaluation or measurement of a subject matter. Against what? Against criteria. Now, all what they are put here, they are big grammar. But I'm going to break it down so that we can understand just as I broke down, just as I analyzed the definition of auditing. Now, one thing that is clear to you here from this definition is that when you are performing an assurance engagement, the person performing that assurance engagement is the name, the generic name for any professional performing an assurance engagement. The generic name is what? You call that person a practitioner, not an auditor. Please note. When we defined auditing that time, or audit that time, we refer to the person being appointed as an auditor, right? In this case, in assurance engagement, whoever is performing an assurance engagement is not to be described as auditor. Rather, that person should be described as a practitioner. Please do not confuse it. Do not interchange it. That is how it ought to be. All right. Now that practitioner, what does he do? He expresses a conclusion. Conclusion means he's going to write a report, right? What that means is that he's going to write a report. And his report, like I said, is similar to, is a type of audit. And I said this is a type of assurance engagement, right? So in that his report, is going to draw a conclusion. And in that conclusion, that is going to state whether the financial statement has been prepared correctly or incorrectly. So whatever he says in that report is what we call a conclusion. It's going to express a conclusion. And that conclusion is going to do what? It's going to impact the degree of confidence. Okay? It's going to impact what? Degree of confidence of the what? Of the intended users. What am I trying to say? Now, there are levels. When you talk about assurance, what does it mean? Let's look at it let's look at the lexical meaning of assurance. What is assurance? Assurance means giving me comfort. Okay? That's the literary meaning of assurance. For instance, I ask you now, give me assurance that you are coming tomorrow. That means I'll tell you, okay, I'll be coming tomorrow. I assure you I'm coming tomorrow. What have you done to me? You have given me comfort that not even if it's raining, cat and dog, I will see you tomorrow. Now you are giving me that comfort, right? That's what we mean by assurance. That is the English word. Now, this assurance, this comfort that he has given you, there are different levels of comfort. There is a way I'm going to say, I will come tomorrow, and you understand that I may not come tomorrow. Do you understand what I'm saying? When I tell you that, oh, I'll come, surely I'll come. Surely I'm coming tomorrow. It means that come what happen, you will see me tomorrow. When I tell you that, oh, I will come, but I am not sure if I will come. What has happened? I've given you a doubt that, oh, my chances of coming tomorrow is like 50%. Do you understand what I'm saying? So we have levels of assurance. In assurance, and there are levels to what? There are degrees to confidence. Okay? That's what we are trying to say. So what we are saying here is that the intended users. Now, when you write your audit report, there are some set of people. We call them in other parlance, we call them stakeholders. But in audit, we don't call them stakeholders. We call them intended users. But what they do ordinarily in other parlance, it should be stakeholders. People that have interest in what you do, we call them stakeholders, right? But in audit, we don't call them stakeholders. Rather, we call those that have interest in what you do, we call them what? Intended users. Number one example of intended users is your government, is our government. How? Government always collect revenue, tax revenue from organizations. When you pay your tax, it's revenue to the government. So government is always looking forward to you paying your taxes. Another one is investor. Investors want to invest in your business. They are always after how your business is being managed. They are also intended users. Creditors that want to give you money or give you some form of whatever you need to run your business, right? They are also interested. So you can call them intended users. You want to get credit, you want to take credit from the bank. The bank that will give you credit want to know whether you're able to have the capacity to pay back the money that you have taken. Do you get it? All of these people I mentioned, and much more, they are regarded as what? Intended users. All right? So what that means is that the practitioner that performed the assurance engagement expresses a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party. What do we mean? So the intended users, they are the people that I just explained. But somebody prepared the financial statement. Somebody prepared this information that the practitioner will use to enhance the degree of confidence of the intended user. Somebody prepared it. The people that prepared it, they are the what? The board of directors and management. They are what? They are the responsible party. So what that means is that the degree of confidence of the intended users other than the responsible party. That is, you are not looking the way of the responsible party now. You as the intended users, you want to be sure that what they have provided to the practitioner has enhanced your degree of confidence as an intended user. Okay? About the outcome or measurement of a subject matter. Now, subject matter here is dependent on the type of assurance engagement. I take it again. The term subject matter here is dependent on the type of assurance engagement. There are different types of assurance engagement. If it's the one that relates to financial information, the subject matter will be financial statement. But if it's the one that relates to other types of assurance engagement, we're going to refer to them in that category as well. I hope I'm making sense. Against subject matter, against criteria. What do we mean by criteria? The only way I can prove that I'm better than you or you are better than me is by what? Is by comparison. Against what? Using data. There's a World Cup that is currently ongoing in US, Canada, and Mexico. It's called the World Cup 2026, right? And a debate has always been on that who is a GOAT. GOAT here means it's not the GOAT that you are going to kill. It's greatest player of all time, greatest of all times. That is the meaning of GOAT. For those that don't watch football, when they say who is a GOAT in football, it means greatest of all times. And two players have always come within this comparison for the past 15 years. Two people have always come to this comparison. Who are the two people? Lionel Messi of Argentina and Cristiano Ronaldo of Portugal. These two people, they are fans that believe that the other one is better. Right? There are some people that believe that Messi is better. There's people that believe that, see Ronaldo, CR7 is better than Messi. The debate has been on for over 15 years. Now, this World Cup that is still ongoing now has further proved that we have a GOAT out of the two of them, undisputed. Why? Because there are facts. We have data that has proven that. Okay? For those of us that don't like football, like I said, when you are trying to explain audit, you must be an all-rounder. You must have different ways to interpret, different ways to explain to students so that if they did not get the concept, the example will make them to remember what you are trying to say. All right? I can use any area to explain anything that relates to audit because everyday life is full of audit and assurance, depending on the way you look at it. And you are going to see this being exemplified in the course of this class from now to the end of the day. You are going to see what I'm saying. Current happenings in the world, I'm using them as examples in this class so that you'll be able to drive home the point I'm trying to make. Now, I'm trying to explain what I mean by criteria. Now, two things. Now, let me just mention two things that has been proven to show that Lionel Messi is the GOAT and not C. Ronaldo. Now, I am not a football analyst, or neither am I a supporter of either of both of them. But for academic purpose, I need to, because anything that you can prove with data is what is substantiated. If there's no data, if they're not going to present data to us now, you don't need to believe whatever I want to say. All right? But we have data to prove what I want to say. Number one data that I want to use to prove it is number one. Lionel Messi has more balloon. There is an award that's been given at the end of the season. Okay? I think it's given by FIFA or so. It's called Ballon d'Or. That is one award. Lionel Messi has more of that award than C. Ronaldo. That's number 1 point. Number 2 point is C. Ronaldo, that is Cristiano Ronaldo, has never won any World Cup. Okay? He has attended 6 World Cup from 2006 to date. Right? To date, he has attended 6 World Cup. The same thing with Messi. Both of them have attended 6 World Cups. Now, both of them have attended, they have played in 6 World Cups, right? Lionel Messi has won World Cup in the last edition, that is the 2022. Argentina won it in 2022. Cristiano Ronaldo that played for Portugal, they've never won it. They will have been in the race to winning it this 2026, but they drop out in their last round of 16 match. They drop out. They were beaten. All right? So that point alone, these 2 points, can prove to say that, oh, one is better than the other. Another thing also you need to know is that Lionel Messi has also scored more goals than C. Ronaldo. We have records to show that. Lionel Messi is closer to scoring 1,000 goals in his career in football. Lionel Messi he's no longer competing in the World Cup, so he might not be able to continue. All right, to get that in this World Cup because he's no longer in competition in the World Cup. The other thing you also need to note here is that Lionel Messi has scored, I think he's the highest goal scorer in this current World Cup. Then he has scored like 7 goals now. C. Ronaldo is no longer in competition. I think he scored maybe 1 or 2 or 3 goals. He's no longer in competition. He cannot increase that number. But Lionel Messi, if this still continues, if they continue to final, he can increase that goal margin. So he might end up becoming the highest goal scorer. He'll get the golden boot. Do you understand what I'm saying? So what I'm trying to say here is that we are using information that is available all over to buttress that point. That is one way. Another way to look at it is looking at it from the angle of using another criteria. Now, when you talk about landed property, for instance, you have heard of when they say you want to buy a land, I bought a plot, I bought an acre, I bought an hectare. You have heard of these things. Now, if you buy a plot in Nigeria and you go to South Africa to buy a plot, the same dimension that they use to determine a plot in Nigeria is the same dimension or measurement they're going to use to sell you a plot of land in South Africa. Even in China, even in other countries, the same dimension, the same measurement is what is used universally. If you buy an acre is made up of 6 plots. If you buy an acre in Nigeria, they will give you, it should contain 6 plots. If I go to Saudi Arabia and I want to buy an acre, it will still contain 6 plots because it has been universally accepted that that is the measurement for an acre. So there is a criteria. If somebody is telling you that, oh, I'm bigger than you, I'm fatter than you, I'm doing this than you, you can use measurement to determine. If somebody say that my house is bigger than your house, ask the person, what's the dimension of your own house? What's the dimension of my own house? That alone can tell you which house is bigger. Do you understand? You can build a big house in a plot of land, in a half plot. You can build a small house in a plot of land, right? But you can use different things. You can use the land, the square meter of the land to determine which house is bigger. You can use dimension of the building, compare both of them, and see which one is bigger. So there must be a criteria. That's what you are saying. You cannot just say something is this, something is that. You must have a criteria. All right? That's what you mean by criteria. I hope that is clear. So what I've said here is that in assurance engagement, the person that does the work is not an auditor. We call the person a practitioner. And that practitioner, what he does is similar to what the auditor does, because I said that auditing is a type of assurance engagement. So he's going to express a conclusion. That report that is going to, that conclusion is like a report that is designed to increase the degree of confidence of the people that want to make decisions, like government, especially your tax revenue, like investors that want to invest in your business, like creditors that want to give you one thing or that to continue your business, like your customers. All of these are intended users. Whether they are going to continue to support you or not, other than the responsible party, meaning the person that prepared the document that is being evaluated or measured by against a criteria. Okay, that is what we mean by that. And that's why I've used that example. Or what you have here, I've used it to explain what you mean by the definition. I've explained, I've simplified the definition to all of us, unless we have anybody that's seen it better explanation. Are we together? Do you have any question, comment, or observation? Question, comment, or observation? Are we together? Yes, ask your question.
Okay. Sorry, I want to get this very way. At
Go
the
ahead.
last sentence, measurement of a subject matter against criteria. Okay,
Yeah.
does it mean that this practitioner, the report that he is giving or she is giving is like a debate?
Like what?
Because like a debate, the report that he is giving, because that subject matter against criteria. How you analyze this football stuff of a team? Is it that the report is giving now is like a debate? Okay, this is what I feel. This is what I measure. This against this, like a debate. So I want to understand that part.
A debate. So what do you say? A debate.
Yes.
It's not subject matter is information that is provided by the management. That's the subject matter. Okay? Subject matter, like I said, is any information that the management presented for what? For evaluation. Any information management presented for evaluation by the practitioner.
Okay.
Is that clear? Information, whatever the information is, that the management they have provided or the board of directors have provided for the practitioner to do what? To evaluate. That is a subject matter. So don't expect it. Don't be fixated that when you talk about subject matter, talking about financial statement. It is not financial statement only. Any document, any information, any report that management presents to the practitioner to evaluate or to measure, it is known as what? Subject matter. So I'm going to give you an instance now. If they present financial statements to the practitioner, what the practitioner will be doing, what the practitioner will be requesting for will be what? Financial statements. But let me give another instance of assurance engagement. Another type of assurance engagement is report on risk assessment. You want to evaluate whether your business is exposed to risk or not. In that analysis, in this situation that I just explained now, it's not your financial statement that's going to prove whether you are exposed to risk or not. You are going to use report that relates to risk management report. Could be risk management report on your business. That is, you carried out a feasibility study. You want to start a business, you carry a feasibility study. There are some government policies that's going to impact on your business negatively. So what do? That policy you are going to state it. That policy is going to impact your business negatively. So that means that the risk that business cannot thrive in such an environment. Okay? For instance, you want to go into car lot, you want to start selling cars now. In Nigeria, as at 1st July 2026, there have been some amendments to the new tax law that says that if you are bringing in new cars, what you are going to pay as import duty has reduced. New cars, you are bringing them to Nigeria, the value, what you are going to pay as import duties as what? Has reduced. Okay? If you are bringing in Tokumbo, fairly used cars from any part of the world to Nigeria, that's also reduced. What does that, what's the implication of that to you having that business? The implication of that is that the prices of cars in a long term, in the short run now, between now and 6 months' time, is going to drop. It's going to reduce. Do you understand what I'm saying? It's going to do what? It's going to reduce. So there is an impact of government policy on your business. All right? So that is, so in that instance now, you're not going to be asking for, let me ask for financial statement. No. What you are going to look at is, what are those things that that makes the prices of cars to go up, that customers are not coming to buy cars. So what that implies is that in the next 6 months now, more Nigerians will buy cars. You remember when this administration started, many Nigerians abandoned their cars, particularly when they increased the tariffs of importation of cars. At the same time, they increased the prices of they increased the pump price of petroleum. Most car owners, they dropped their cars. Some converted their cars to a smaller car. Those that are using SUV before started using cars that are fuel efficient, just to be able to pull through in this economy. Do you understand what I'm saying? So there are different types of engagement. We are going to look at that as we advance, we're going to look at that, okay? So that will inform what determines your subject matter. What I just want to say, I just want to disabuse your mind from saying that when you talk about subject matter, you are referring to financial statement. That's what I'm trying to say. Is that clear now, Madam Amarachi?
Yes, very clear. Thank you.
Okay. Any other question? We are good, right? So I've used that to explain all of what you have here. Before, all of what we have here, all these ones here, I've explained it. Okay, I've used different things to explain. So if you can go back and read, you see that all what is here, I've already explained it. So there's no, I'm not reading in verbatim. I'm discussing with us. I've already read it, and I'm trying to summarize what I've read so that it makes. If I'm reading in verbatim, most of us will have dozed off by now. That's why I'm taking it, but I already internalized it. And what I'm giving out is more like a discussion we're having. All right. We go to the next area, element of an assurance engagement. What does this mean? What this means is that anytime you want to talk about assurance engagement, you must look out for 5 elements, 5 characteristics. Elements could be what? Characteristics. It could be attributes. Okay? It could be characteristics, it could be attributes. It could be elements, right? So you look out for these 5 factors. If these 5 factors are not there, you don't have an assurance engagement. But if these 5 factors are there, then you have what? An assurance engagement. What are those 5 factors? Those 5 factors have been christened. I gave it a name. That name is called CREST. CREST, CREST. That is the name I gave to this element, CREST. Now, what do we mean by C? C symbolizes what? Criteria. I take it again. C symbolizes what? Criteria. What am I trying to say? What that means is that when you are trying to perform an assurance engagement or carry out an assurance engagement, you must have a criteria, what you want to use to measure or to evaluate what you are trying to do. If there's no criteria, you are not carrying out, you are not performing an assurance engagement. That's what the C stands for. R is report. At the end of the assurance engagement, the practitioner is expected to write a report. That report is where you are going to draw your conclusion, to take your position, or to take your stand on what has happened or what you have examined, whether everything you have examined is in order or not. That is going to assist the intended users to take their decisions. Is your report, we call it assurance report, is your report that is going to stand in, that's going to aid the decision making of the intended users. That is what your R stands for. The E you have in assurance engagement is evidence. So in every assurance engagement, you must have obtained information that is what? That is sufficient. And that is what? That is appropriate. What do I mean by sufficiency? For you to conclude, for you to be convinced that this is what has happened, you are going to base this on information that you have gathered, or information that you have obtained. Right? Now, that information that you have obtained, you must also be mindful that that information is what? Is appropriate. Now, appropriate is measured from two areas. It's measured from, first of all, relevance. That information that you have gathered, how relevant, how related is that information to the assurance engagement you are trying to do? That is one. The second one is reliability. Reliability is talking about who provided the source, who provided the information, the source of that information. How credible is the source? So, when you are trying to obtain evidence, it's expected that the evidence you are trying to obtain must be what? Must be sufficient in terms of what? Volume. In terms of what? Volume, that is quantity. And it must be appropriate in terms of what? Quality. So anytime you are writing evidence, always include this prefix. Sufficient and appropriate evidence must be stated. All right? So this is another terminology that you have learned this evening. So when somebody is saying that you are writing your exam, you're answering a question, and say the practitioner will gather information, and that information must be all of that. If they want to award you mark, by you putting the practitioner will obtain information, and you put it there. And the other person wrote the practitioner will obtain sufficient and appropriate audit evidence. That person that has included sufficient and appropriate audit evidence will get more mark than you that have used information gathered in there. That person will get more mark because that person has used the audit terminology, the appropriate audit terminology in that situation. Okay, that is evidence. I've talked about criteria, reporting, and what? Evidence. The next one is the subject matter, S. S means any information that is provided by the management. Any information that is provided by the management to the practitioner is subject matter. So it's not restricted to only financial statement. It's not restricted to what? Financial statement only. Okay? So always have it at the back of your mind. Then the last one, T, is three-party relationship. Three-party relationship. And this three-party relationship, you have the practitioner. Who is the practitioner? The person that has been engaged to perform the assurance engagement. The person that has been engaged to perform the assurance engagement. Who is the responsible party? The management or the board of directors. Anyone, whoever is the management or the board of directors is the responsible party. Then who are the intended users? Intended users are people that are going to utilize the assurance report to make decisions. So that is CREST. So Madam Awuli, Madam Amarashi, I can see your hands up. What's the question?
Okay. Okay, sorry, I didn't get you when you were talking about sufficient appropriate. You said it's measured in two ways: the relevance and the second one. I didn't get that.
Reliability.
Okay,
Relevance
thank you.
and reliability. Are we together?
Thank you.
Okay, so you can put down your hand now. Okay, so we continue. Any questions so far? We are good, right? So you can see that I've explained this one now. Just now, I just finished explaining it. All right. So let's continue. We are moving on
Excuse
to
me,
the next one. Yes, ask your question.
please, I wish that you go through the elements of assurance engagement once more, please. Thank you.
I said the elements of assurance engagement, I have coined out a term. Okay. So what I'm trying to say is that just like a way that to make learning easy, I've coined out a term from that element. What that means is that anytime you're talking about assurance engagements, you must look out for these terms. You must look out for these factors. You must look out for these characters. If they are not there, you don't have an assurance engagement. And the term, what I've coined out from it is what is called CREST. CREST. C for criteria. C is for criteria. R is for report. E is for evidence. S is for subject matter. T is for three-party relationship. CREST. The C, like I said, is a criteria. Anytime you are performing an assurance engagement, you must have a basis for comparison. There must be a benchmark. You want to examine financial statement. You cannot examine financial statement in absentia without referring to IFRS. It's not possible. So you have to look at IFRS and see how the IFRS can be used to interpret some of the information you have in the financials, whether it is presented in the way it's supposed to be. For instance, revenue that's covered under IFRS 15, revenue with contract, right? You have IFRS 15, says that you should not recognize revenue until when it is what? Until when it is earned. So for instance, you sold goods to someone now, and the person, you sold it on credit, and you have recognized that as revenue. Should that be so? That is not supposed to be, because that has negated what you have in IFRS 15 as definition for what? Revenue. Until when you receive that money, you have not earned it. Is that clear? So you are going to ask questions. When you see revenue, you are going to ask them, how did you arrive at your revenue? By the time they are explaining to you, you know that, oh, the way they have captured as revenue is correct or not correct. Is that clear? The second one is R, which is reporting. When you are done with the assurance engagement, you are expected to write a report. And in your report, your assurance report, you must take a position whether the responsible party, they have done the right thing or not. You must let the intended user, let them know. So that when they want to make decision, they can make decision in that regard. All right? That's what they mean by a report. You don't just write a report and say, the report is okay, I think we are good. You cannot sit on the fence when you are writing your report. You must take a position, whether right or wrong. You must let the intended users know. Or the owner of the business, let them know. Then you have evidence. And I said, under evidence, it talks about the information you'll be able to gather in the course of the performance of the assurance engagement. The information you're able to gather, the information you're able to obtain. And in the course of obtaining the information, you have to be mindful of how you get the information, who gave you, who furnished you that information. Okay? And the information that they have given to you, is the information relevant to what you want to do or what you want to achieve or what you are performing? You have to have that. All right? Then you must ensure that that information is it complete. That's where the quantity comes in. if it's complete, if it's much. Sometimes the quantity does not really mean it makes a whole lot. It makes a whole lot. It influences whatever decision you are going to take. That is the volume of information that you have. You're supposed to get like 10 information to confirm an argument, but you're only able to get like 6. That is not sufficient. It might affect your decision. Okay? Then the one I made mention of, that is, you must ensure that information is related. We are talking about the appropriateness of the information, of the evidence. That is, it must be relevant and it must be what? Reliable. Who provided that information? The source of that information. That is why I always say that anytime you want to talk about evidence, always put sufficient and appropriate evidence. Okay? Then you have the S. S is the subject matter. Subject matter is any information, report that has been presented by the management or board of directors to the what? To the practitioner. That is subject matter. I did not say financial statement. I said any information, any report. Okay? The type of the engagement will determine the type of report, the type of report that will be presented by the management. All right? Then you have the three-party relation, which is the T. And I made mention of the fact that you have the T, three-party. Yes, you have the practitioner, is the person that has been assigned to perform the assurance engagement. You have the responsible party, that is the board of directors or the management. Then you have the intended users that I've explained earlier, that is government, bankers, creditors, customers, investors, etc. Is that clearer now, sir? Is that clear now, sir? Okay, so let's continue. So we move on. We move to the next one, right? So let's go. We are through with this side. Sorry, that's what I was trying to avoid. Okay, let's go on. Now we move to the next one. We just finished discussing element of assurance and engagement. So let's go to the next one. The next one we are looking at is type of assurance engagement. There are 2 types of assurance engagement, 2 types. We have the assertion-based and you have the direct reporting engagement. What's the difference between the 2? When you talk about assertion-based, what that means is that the responsible party is the one, that is the management. They are the one that is evaluating the report on behalf of the intended users. So I take it again. When you talk about assertion-based engagement, we are saying that the management or the board of directors, they are the one that is evaluating. They are sending their report to the what? To the intended users. That is, for instance, you have the management account that is prepared by the responsible party. That is the directors or the board of or the management, right? They prepare it and they give it to the owners of the business. That is an example of an assertion-based engagement. You don't have an independent person in there involved in that process. Then we talk about the other one, direct reporting engagement. Now, in direct reporting engagement, you have a practitioner that is involved. There is an independent person that has been involved, that has been engaged to carry out that particular engagement. Okay, you have that practitioner involved in that kind of engagement. So in that regard, you call it a direct reporting engagement. When you don't have the practitioner involved, what you are doing is called an assertion-based engagement. An assertion, another way you look at assertion is just for the person just to confirm that something has been done. You are bearing witness. Somebody say that, oh, have you prepared? Have you sent the management account? Yes, I've sent it. Okay, that's an example of what? An assertion-based engagement. But where you have the practitioner involved in that engagement, you have what is called the direct reporting engagement. All right. So that is the two types that we have. Any question? Any question? We are good, right? Let's continue. I know the time is fast spent. We're supposed to stop by, I think we're supposed to stop by 11, but let's see how far we can go. We might not be able to finish, but let's see how far we can go. All right. Any question? Any comment? We are good, right? Please respond, though, that I will know that I'm not alone here. So we move to the next one. Types of assurance levels. Now, like I said, there are degrees of confidence. Okay, like I explained earlier, there are levels to assurance. You have levels. Now, where the practitioner is giving all the necessary information, where the practitioner is supplied with all the necessary information that is needed to draw up his conclusion, and that information or that information that is being provided is correct, that is, the practitioner can go to any length to defend that information because he looks at the accuracy or the correctness of that information, then you have what we call a reasonable assurance level. I take it again. Where you have an engagement where the practitioner is provided with all information needed and that information is correct, the practitioner can go to any extent to defend that information. We call it what? A reasonable assurance level. But where the practitioner wants information and that information is not provided to the practitioner, rather they say that, oh, we don't have that particular information, but we have a substitute, we have a replica, we have something that is related to that information. We talk about a limited assurance level. You call it what? A limited assurance level. What do I mean? So for limited assurance level, let's start with the first one, reasonable assurance level. What does that mean? So I want to audit an organization and I asked for all information, records, all of this. They provided everything to me. They even went ahead, they went beyond my expectation, and they gave me information that I did not even request for. And when I gathered all this information, I saw that all the information provided is in right order. So what that means is that anywhere someone wants to counter what I've done, I can beat my chest and say, I know what I have done. They have given me the information that I need or that is needed or required. I can defend it to any level. But when you ask for certain information, you only want to audit financial data, then sir, give me your payroll. There's no payroll, no. But we have a schedule of payment that we made last time. That one can suffice. You ask for asset register. We don't have asset register, but we have some list of assets that we bought. They are just very scanty, maybe 3 or 4. They are there. What that implies is that they are not being truthful. They are not coming forth with the information that you needed. So when they don't give you the information that you needed, what you are going to say is that, so that you don't implicate yourself in future, you are going to say that what they are giving to you represents or present a negative form. Now, negative form means, please note, when you talk about negative in audit, does not mean bad. What it means is that you only acted based on the information that is provided. They did not give you that information. So the information that is provided is what you use to arrive at your conclusion. So for instance, a fraud happened in an organization, and they asked, and before you came, before they appointed you, they've already cleared the mess. All the traces of fraud, they have already cleaned everywhere. And you did the forensic engagement of forensic accounting. When you are done, you did not find any fraud. And the manager says that you did not do your work very well. And what will you ask them? What will you tell them? You tell them that I did not see any evidence to show that fraud has happened in the organization. Why? Because they presented a false narrative to the practitioner. So because of that, the practitioner will say that I only acted based on information provided. So in that instance, there is a limitation. We call it what? It gives a negative report. So in that negative report does not mean it is negative as it is, but it's negative in the sense that it's based on the information. The practitioner is limited to the information that is provided. So when they don't give all the information, they add back some of this information, some of this information or that information is going to affect the degree of confidence that the practitioner is going to give to the intended users. Is that clear? That is what we have in all of these places. They just explain. That's what we have there. You ask for this, they did not give you this. Like I said, there are two levels. There are two recognized levels to assurance engagement. We have two levels. We have reasonable level of assurance and we have limited level of assurance. But there is a third one, and that third one, we don't talk about it. Why? Because it is not feasible. We cannot get it. It is not what? It is not feasible. Why is it not feasible? These are the reasons why we don't have. We call it what? That third one is called absolute level of assurance, but we cannot attain it. It's not feasible. Why is it not feasible? These are some of the reasons why it is not feasible. Number one, lack of precision. Lack of precision, often associated with subject matter. What does that mean? I've talked about subject matter, and I said what that means is that any information that the management presents to the practitioner, and more often than not, when they present this information, there is no time that this information or this report being presented to the practitioner is always 100% correct. There are always some errors there. So those errors might be negligible, they might be much. Okay? So because you don't have 100% accuracy in the record being furnished, you cannot have absolute level of assurance. Okay? Number two, another reason you cannot have absolute level of assurance is the nature and timing of the audit procedure. Now, there are set times to perform some audit procedure. For instance, I want to do cash counts now. I want to do stock counts. There are set times you're supposed to do it. When you don't do it, when you don't do them at those times, what happens? It means that you cannot get the same result that you expected. You want to do stock count at the end of the month. You went and did it on the third day of the month. How will you get the value? You will not get value because you're supposed to use end period to determine what your stock count report is. Do you understand? Then another thing you also need to look at that also makes it impossible is the fact that evidence is usually passive rather than what? Conclusive. What does that mean? Now, if I'm somebody that can convince you, I have that sweet mouth, right? If I'm somebody that has a sweet mouth, that I can easily convince you, whether what I'm saying is correct or not, you are going to believe me. Okay? So, and that's the same thing with audit. So if the practitioner, if the practitioner has not done what's supposed to do, but when he's presenting his report, he has presented a narrative that he has done all the needful. What does that mean? What that person has done is that the evidence that is presented is what? Is persuasive. Is able to convince the users of that information. Is able to convince the intended users, okay? Rather than what? That he has done a good job. He's able to what? Convince them. That's what it means. The other reason you cannot have absolute level of assurance is the fact that evidence is gathered on a test basis. Like I explained earlier, we use audit sampling or risk-based audit. So if you use audit sampling, definitely you cannot obtain absolute level of assurance. It's going to be what? It's going to be limited. I mean, it's going to be either limited or maybe limited. You cannot have absolute. It's going to be limited when you are using test basis. You're only taking a sample. Okay? It can be limited or reasonable. You cannot have absolute level of assurance. Then the last one is the completeness problem. What do you mean by completeness problem? Now, completeness problem here means that what we are saying here is this: if you have a defective population and the practitioner draws a sample from that defective population, whatever he's going to do, whatever his conclusion will be based on the sample he has obtained. And like I said, sampling is what? Taking a percentage of the population and using that report to conclude on the population. That is what we mean by audit sampling, okay? So for instance, if somebody says all men are bad, if a lady says all men are bad, what that implies is that lady, let's say we have 5 billion men all over the world. That lady has interacted with 5 billion men all over the world. And our own conclusion is that all men are what? Are bad. Is that the true position? The answer is no. Or some guys will say all ladies are bad, or all ladies from this particular region of the country, they are bad. So you need to ask the person, how many of the ladies has the person interacted with? So if the person just used 3 people and use that to conclude, that means it's not being justifiable. For you to say everything is bad, it means that you have sampled everything, you have tested everything, and you have that general conclusion. But if one person treated you badly or 2 persons treated you badly, you use that to conclude on whether it's gender or the behavior, then you are doing the service to that particular situation. That's what we mean by the competence problem. All right? Any question? Any comment? Any observation?
Yeah, I have a question.
Please ask your question, sir.
Okay, in a real world setting, you have a situation where a client would want you to test everything. You go to the field and you are conversing with the client. He says he wants, you try to explain that this is the nature of job, or rather what you have to do, what you are going to do. And the client would insist that you go through everything. So, I guess you just have to listen to or abide by what the client has said and do the needful instead of because he requested. Because I personally have gone experience such, and the client will tell us that he would prefer that we go through everything.
Okay. So are you done, sir? Is that the
Yes.
question? Is that questions?
Yeah,
So
it's like
if
a
that
comment. It's a comment. It's a
is a
comment.
comment, okay, good.
Yes.
So in that situation, right, what you are doing at that point in time is called agreed upon procedures. What you are doing at that point in time is referred to as what? Agreed upon procedures. So let me give an instance. So you are doing an audit for a client. You are looking at the business as a whole. So you are doing external audit for the client. And the client says that I want you to pay close attention to my inventory because the information I have with inventory, I'm suspecting that there is theft going on there. So, because you are doing a general audit or external audit, right? You are doing that one. Now, he has given you another assignment that in the course of doing that audit, please focus more on what? My inventory. I want you to check everything in that inventory. That one is called an agreed upon because both of you agreed. You consent that okay, I'm going to check everything based on what you want. That's what you call an agreed upon procedure. In that instance, you are not performing an assurance engagement in that instance. Because I said it, how do you know that you are performing an assurance engagement? CREST must be established. And for what you've just told me now, the example I just used now, you only have 2 parties, not 3 parties. It's yourself and the management. It's yourself and the client that have resolved that this is what I want you to do. In that instance, you don't have an assurance engagement. You have what? an agreed upon procedure, which is a type of audit-related services. I want you to answer your question, Mr. Precious.
Yes, I'm
Mr.
satisfied.
Precious?
Thank you very much. Yes,
All right.
thank you very much.
All right, so we move on. So we look at that. We go to the next area, statutory audit. What do you mean by statutory audit? From the word statutory, it means it's compulsory. That is, by law, it is required. All right? So the law in Nigeria says that once you have a company, you must be subjected to annual audit. You must, at a point in time, once in a year, in your organization, to subject your company to what? External auditing. That is what we mean by statutory audit. But that same law still says that, okay, yes, you have a company, but you still have some categories of company that has been exempted from statutory audit. We call those company small company or a small company. So when you have a company and that company, by the regulation, by CAMA, does not fit the status of a company in that regard, then that company will be seen as a small company. So let me take it again. The law, CAMA, says that once you have established a company, you must subject it to audit annually, external audit annually, at least once a year, right? That same law says that, yes, that is what we said, but we have some exceptions. And those exceptions are companies that the law has regarded as what? A small company. So CAMA that says that you must audit your activities every year still gave exemption to some companies that if you meet this criteria, you are classified as a small company. So you are not mandated to subject your company to annual audit every year. So you are going to exempt them from annual audit. We call those companies small companies. So for you to say that a company is regarded as a small company, it has to satisfy these conditions. Okay? A company will be exempted from carrying out, from conducting audits, statutory audits, if we meet this condition. Number one, that company, since its incorporation, they have not carried out any business. So you form a company 5 years ago, but no operation, no trading has been done since 5 years ago. That company can be classified as a small company. That is, that company should not be subjected to, because what are they going to audit? They have not carried out any activity, so they cannot subject them to. So it will qualify as company that is exempted from what? From statutory audit. Number two, when the company is regarded as a small company, it's also exempted from statutory audit. So we have two companies that are exempted from statutory audit. When the company has been established, but they have not carried out any business since their incorporation. And number two, when the company is regarded as what? A small company. Now, what's the definition of a small company according to CAMA? CAMA 2020 stipulates that for you to say that a company is a small company, number one, it must be a private company. It means that they have not sold their shares to investors. The business is being managed by the owners. We call it a private company. Number two, any company that is turnover is not more than 120 million or such amount as may be fixed by the commission from time to time. Commission here means CAC, Corporate Affairs Commission. So for as it is now, once the turnover, the sales of that company is not up to 120 million, it's regarded as what? A small company. And also, its net assets value is not more than 60 million or such amount that may be fixed by the commission from time to time. So if the CAC, Corporate Affairs Commission, says that a small company is one that has net asset value of no more than 60 million, That's a small company. They also put it there. For you to say that your company is a small company, none of its members is an alien. What does that mean? You must not have any foreigner. For instance, you have two companies now. You have a company, you have all Nigerians there. You now have one Ghanaian there. That Ghanaian is an alien. So because you have a Ghanaian there, you don't qualify as a small company. So for you to say it's a small company, there should be no foreigner. And there should also not be any member of government. There should not be any government representative. Oh, this person is representing the board of the national federal government, so and so, federal ministry of so and so. Once you have a member from the government, agency, department, or ministry, then it's not a company. Then lastly, the directors of the company, they must have at least 51% of the equity share capital. They must have what? 51% of the equity share capital of that company. I hope that is clear. So once any company fits into this category that I just mentioned, in this condition that I've just read out, that can be classified as a small company and they can be exempted from statutory audit. I hope that is clear. Any question? So we move. The next area we are looking at now is eligibility to act as an external auditor. Now, let me quickly explain this. For you to act as an external auditor, there are two approaches to it. Either you use the self-regulation approach, self-regulation by the profession approach, or you use the regulation by government approach. I take it again. For you to be eligible to act as an external auditor, you have to use two approaches. You have two approaches. Either of the approaches can be utilized. Number one, you have the self-regulation by the profession approach, and you have the government and regulation by government approach. What's the difference between the two? Now, if you're talking about self-regulation by the profession approach, what that means is that there should be a professional body or regulatory body that has been assigned or mandated to be doing all of this for the audit profession. Number one, it must be able to offer professional qualifications to auditors. Okay, we're able to organize exams, offer professional qualifications for auditors. Okay, for them to be able to process the minimum level of technical competence. That's number one. That's just like ICAN that we just talked about. Number two, they must establish procedures to ensure that the professional competence of auditors is maintained, such as they must ensure that audit is done by fit and proper person. Fit and proper person here means person that understands how to carry out an audit. Okay? That has an understanding of how to carry out an audit. That he has undergone training, different trainings. Okay? Who act with professional integrity. Number two, under these establishing procedures is to require that the person carry out their audit work in accordance with appropriate technical standard. That is, there are some auditing standards that must be complied with when performing the audit. And we're going to look at them as we proceed in this class. All right? So that is then others that you need to also, if you are looking at self-regulation, I think there are two approaches: self-regulation by the audit profession and regulation by government. We are still under self-regulation by the audit profession. That's what we are still looking at. Okay. So in that case, what we are saying is that you have ICAN and we have in Nigeria now. Ensuring that auditors remain technically competent, up to date with modern audit techniques. That is, ensuring they have what a mandatory continuing professional development. Like the one ICAN does. What they do is that they keep continue to train auditors. Like I am now, I've been a chartered accountant and I've been auditing. Okay, so that means if I've not been going for regular training, seminars, webinars, and the likes, I cannot stand before you now. Okay, I became chartered over 15 years ago. Okay, so if that knowledge I had that time is what I'm still using, I cannot stand before you and say I want to teach. You understand what I'm saying? Because of the updates in training that I've benefited from year in, year out, I've been updated with the knowledge that can be impacted in young aspiring accountants. Okay, then all those bodies too, the regulatory body, They must have a procedure used to monitor and enforce compliance amongst their members. They be able to discipline their members when they do wrong. When they are involved in malpractices, they should find a way to sanction them. Like the certificate you are trying to obtain now, on the day of your induction, when you become chartered, when you go for induction, they are going to give you a certificate. That's how they put it there. This certificate belongs to the institute. That's what they are going to put there. You don't say, it's my certificate. They put it there. Anytime you have found one thing, they can recall that certificate. That's what it means. But that's not our portion in Jesus' name, okay? Then, if we are talking about self-regulation by the audit profession, they must establish procedures for the investigation of complaints against. So when men have been reported to the regulatory body, they must not say, no, don't do it. And they are these people, they are sacred cow. They cannot be investigated. Not like that. Not like the case that we are discussing in Abuja now about this presidential one committee or one office of the presidency that is being regarded as a fake agency now, government agency. That case that is on that involves one Adeyemi and Co. and Bajabi Amila. Okay? So that and you are saying that we cannot investigate, you can do this. In that instance, all the report is able to do the necessary investigation and arrive at whether the practitioner or the accountant or the auditor has committed the allegations or not. There should be an avenue for that allegations to be investigated. Okay? Then that is the first one. That is what if you have like ICAN, and that's what ICAN is doing as we speak. So countries can adopt either you use your professional body as a self-regulating for the audit profession, or government will set up its own parastatal to do that. So we'll come back to this one. So when government set up its own parastatal to do that, we're talking about regulation by government. We're talking about what? Regulation by government. What does that mean? Rather than for them to give it to ICAN to do, government can set up like an agency like NAFDAC. I'm just saying NAFDAC. It might be an agency of government. You can call it any name. It can be NAFDAC, okay? And okay, you NAFDAC. What you are going to be doing is that you are going to be doing the work of ICAN. You will be training people. You will be training auditors. You ensure that you monitor their activities, okay? You ensure that when they do something wrong, you will be able to investigate and come up with what? With recommendations of what to do, whether to sanction or not to sanction. Okay? So those are the two approaches that we have. We have self-regulation by the audit profession, like in Nigeria, that is what we have adopted. When in some countries, they have adopted regulation by government is one doing everything. Okay? So that is the difference between the two. The one that is being done by a federal body, or the one that the government will be the one that will be solely responsible to putting that in place. That is regulation by government. These are the two types of eligibility to act. These are the two approaches to eligibility to act as an external auditor. I hope that is clear. What I just explained is this one that we are talking about, eligibility to act as an external auditor. There are two of them: self-regulation by the audit profession or regulation by government. Those are the two. Any question? Okay, we go to the next one. The role of auditing standards. Now, as auditors, right? As accountants, first of all, we are guided by the standards, accounting standard, the IFRS and the IAS, right? So for auditors too, they also have their auditing standards, and they have different types of auditing standards. We have the one we call ISA, International Standards on Auditing. ISA, International Standard on Auditing. We call it ISA. Okay? We have ISQM, International Standard on Quality Management. We have it. We have ISAE, National Standard on Assurance Engagement, and so on. Right? Now, all of these standards are issued by the International Audit and Assurance Standard Board, IAESB. The International Auditing and Assurance Standard Board. Those are the people that make that publishes these standards. Okay. Now, these standards that we just talked about, what they do is that they serve as a guide to the auditors when they are performing their engagement. It serves as what? A guide. It guides them on how to go about, because it tells them what they need to do so that it makes it easier for them. Okay? Now, what this helps to do is that it helps to make them to be more professional at what they do. Now, these standards that we just talked about now, all these guidelines, auditing guidelines we just talked about now, there's a process to making them. We have a process to making them, and that talks about producing a new ISA. There's a process. What is the process? So when you, as an auditor, when you do your work, when you perform your engagement, your assurance engagement, and you stumble on some challenges that has become recurring over time. These challenges has been reported by several practitioners, and there is no way out. They will not be able to provide a way out of it. So what happens is that at some point, right, that complaint, those challenges will get to the standard issuing body, that is International Auditing and Assurance Standard, IASB. It will get to them. They are going to do a study. Okay? After they have done their own study and research, they are now going to send it as a document to all the professional bodies all over the world that are members of that IASB. ICAN is a member of the IASB, okay? So you send it to all the professional bodies all over the world and ask for their input. So they are going to furnish their input. They are going to send their comments. At the end of the day, all of these comments, they'll give them a deadline for submission. So after the submission date ends, IASB will collate all these comments. They are going to scrutinize them one after the other. They are going to fine-tune it, okay? And they are going to come up with a new standard. That new standard is what is going to be published to every professional, that this is a new auditing standard. That is, going forward, when you want to do audit, you must follow these standards. That is how auditing standards are established. Okay? That process. There will first of all become challenges. That challenges will get to a point that is going to be escalated to the IASB. IASB will carry out a research on it, and when they are done with the research, they are going to send that document asking for input to all their member bodies, and they're going to give a deadline to it. Okay, all right. When they give a deadline to it, they expect that everybody should send. So after the deadline lapses, they are now going to collect everything and fine-tune all those comments to coming up with a new standard. And that new standard will now be the new auditing standard. Okay? So that is that. All right. So what you also need to note here is that every country, they have their own local auditing standard. In Nigeria, we have our own Nigerian Standards on Auditing. It's being published by the Financial Reporting Council of Nigeria. I take it again. Every country has their own local auditing standards. In Nigeria, we have the Nigerian Standards on Auditing, and it's been published by the Financial Reporting Council of Nigeria in conjunction with ICAN. Okay? So when there are conflicts between Nigeria, the local standard, and the international standard, what normally happens is that the local standards always take supreme, always preferred to the international standards, international auditing standard. Why? The only time the international standard will take supreme, will be preferred to the local standard, is when there is no local standards. If you have local standards, local standard will be preferred to the international auditing standard. But when you don't have any local standards, local auditing standard, then the international standard auditing can be what? Can suffice in that regard. Okay? That is what we have there. Now, in any auditing standard, it contains the following. It has it's a document, right? That document contains an introduction, what the standard tends to achieve or address. Then how do they want to achieve that, or how they have achieved that is the objective. Then there are some keywords that they have used in that standard that needs to understand the application in that standard. Okay, so your understanding of any word before now might be different from the way it is used in that standard. That's why they are going to look at the definitions. Okay, then they are going to talk about requirements which are shown by the word shall and are to be applied as relevant to the audit. Then it also, what that means is that they are going to say that you shall, meaning that it's not a force, it's not by force, but it's a word of saying that it's a must, that you must do it, or it's better if you do it that way. You achieve a better result if you do it that way. Then application and other explanatory material, which is for guidance purpose. So in sometimes also we have some other information that will further give clarity or further give clarification on what that standards intends to what to achieve. Okay, so those are the things. All of these are the standards that I just made mention of. All of these are the standards that I've just made mention of. When I talk about Nigerian standard on auditing, I've already talked about Nigerian standard on auditing that has been issued by the Financial Reporting Standard in conjunction with ICAN. I'll talk about that also. All right. So I've talked about this one, to regulation by government. Then we'll go to the next one. What are the advantages of statutory audit? I'll talk about statutory audit. What are the advantages? Okay. Some of the advantages of statutory audit is that when you carry out audit, it gives credibility to the published accounts. It gives credibility to the published financial statement. Okay. It also confirms that management have performed their statutory duties correctly, because it's going one of the highlights of the auditor is to ensure that financial statements are prepared in line with applicable financial regulatory framework. Okay. It also provides assurance to management that they have complied with non-statutory requirements. That is, there are some requirements that are not binding by law, but in one way or the other, they have been able to get it done in that regard. Then it also gives an evidence on the effectiveness of the internal controls. So when you do audit, when you perform an audit, or when you perform statutory audit, you are going to report on whether the internal control system is strong or it is weak. You have to talk about the effectiveness of the internal control. All right. Now, some of the challenges or limitations of statutory audit is that number one, audit fee is usually high. The cost is usually high. Number two, sometimes when you are doing statutory audit, it disrupts operation within the company. That time you want to do stock counts now, which is supposed to be part of element of the statutory audit. So that you might need to stop operation for a while for you to carry out the stock count, and that disrupts operation. Number three, some items in the subject matter might be estimates whose truth and fairness may not be known with certainty until some point. So you have so many estimates. Like you have the IAS 8 that talks about accounting estimate and prior year adjustment. So you make it, sometimes you don't have the actual figures. You make use of estimate, and that estimate is based on assumptions and some assumptions and maybe theories. Okay, so and those theories sometimes might not be confirmed to be true. You just have to look. What we just do is to look at how reasonable are those assumptions and estimates. That's what we normally do. Okay, so when we see some level of reasonableness in that assumption, we can let go. But sometimes some of these things will not crystallize, you don't get to understanding much later until when it happens in the future. Okay, the other limitations of this is that most fraud will include an attempt to deliberately conceal the truth or misappropriate information. So when they don't do audit, certain fraud can go undetected if you don't do audit. Okay, it can go undetected. Then others, audit evidence is persuasive rather than conclusive. What that means is that it depends on who is doing the audit. If the person doing the audit can convince more in terms of his word is suiting, he has sweet mouth. You can use that sweet mouth to convince you that he has done, whereas he has not done anything. So that's another limitation to the statutory audit. Then To balance cost and efficiency, the auditor routinely uses sampling rather than test. So another limitation is that they don't check everything. They use samples. Okay, they use audit sampling or risk-based audit. These are some of the challenges or limitations of statutory audits. All right. Any question? Any question? Any question? Any comment? Any observation? So that takes us to the last part of it, okay? So the statutory audit, at the end of the day, you are going to write a report, okay? Now, the report you are going, the audit report you are going to write, it needs to be, it can be in two forms. It can be a type 1 report or a type 2 report. A type 1 report is a report that is not detailed. It's just a summary. It contains summarized information. So, and if the information is summarized, not everybody will be able to comprehend what is the quality of that report because some of the information is already summarized. So it's only for some set of people that have knowledge about what that report entails. Whereas the type 2 report is an audit report that is more elaborate, well detailed. So all that information that is summarized is explicitly explained, explicitly stated in audit report 2. Okay, type 2 audit report is explicitly stated. And also, you need to also understand that the audit report that we are using these days, we always have a section in that report that talks about CSR, corporate social responsibility, or we call it sustainability report. Okay, so most companies now, investors are not interested in how much profit you have made. Rather, they are interested in how much you have given back to the society that produce that profit. They want to see how you've been able to improve on the social well-being of the people in that area. How many of the people in that area have you employed? That's social well-being. Okay. How much have you destroyed that environment with your pollution, noise pollution or chemical pollution, whatever? Okay. For instance, you set up a company in an environment that's supposed to be residential and you run your generator 24/7. It's going to cause pollution, noise pollution. Where babies are supposed to be sleeping, where elders are supposed to be resting, the sound of the generator is polluting the environment. Not to talk of the fumes that comes from the generating plants. All right. So you want to see how you'll be able to contribute meaningfully to the environment and to the what? To the social, economic well-being of the host community where your business is situated. So that's why it's that most organizations now, they're involved in corporate social responsibility activities. Okay, they give a scholarship to indigent students. They help to repair, they help to provide borehole. Sometimes they help to build clinics. Okay, sometimes they help to do some repairs on our road. For those of us in Lagos, you saw that at some point Dangote had to embark on civil construction, and why he did it was to reduce his tax liability. So the cost of constructing or rehabilitating those roads are used to reduce. They gave him some form of tax credit that he used to defray or to reduce his tax liability as a business with the government. Okay, so it's an avenue that can be used to reduce our tax liability, and it also helps to show that the organization is responsible. Okay, it's a responsible organization that contributes to the advancement of its immediate environment. So with this, we are done with chapter 1. Any question? Any comment? Any observation? Question, comment, observation? Are we good? Are we all good?
Yes, sir. Yes.
Thank you. Thank you very much. I want to believe that Mr. Precious is speaking for every other person on this call right now. I know it's late, okay? And there's no need for you to worry. For those that have logged out, this recording will be sent, will be shared, okay? So if you are maybe there is something that you missed, you are going to receive copies. You're going to receive copies of, a recording of this class that will be shared on this platform for you to listen to over and over again. And if you have any question, please feel free to reach out to me. Okay, you know my number. My number is there. Your number is there, and it bears my name. So if you have any question on any topic that we are still going to treat, please reach out to me. Reach out to me by WhatsApp, reach out to me by call, reach out to me using text messages. I'll be more than glad to respond to all your questions. So if there is no question in this class, this chapter 1 that we just had, the concept and need for assurance. So we call it a day for today. So the next facilitator will take you up next Thursday. We always meet Thursdays, 8:30. All right, 8:30 to 11. So all the best and have a good evening. Good night.
Good night, sir.
Good night.